Warren Buffett once said, "The best investment you can make is in yourself." But did you know that one of his biggest influences was a book, The Intelligent Investor? Buffett has often called it his Bible when it comes to investing. Imagine learning the same principles that helped him build his empire. This book isn't just about investing, it's about mastering the mindset that could make you the next big success story. If you want to learn how to think like the world's most successful investor, stick around because we're breaking down the power of the intelligent investor. Alright, let's start the first chapter. Chapter 1. Investment versus speculation. In this chapter, Benjamin Graham makes a clear distinction between investment and speculation. Investment involves putting your money into assets with a clear expectation of long-term value based on solid fundamentals. For example, if you invest in a company because you believe it will grow steadily over time and generate profits, you're acting as an investor. Speculation, on the other hand, is about making bets on short-term price movements, often with little regard for the actual value or long-term prospects of an asset. An example of speculation might be buying a stock because you expect its price to rise quickly in the next few days or weeks, without considering whether the company is fundamentally sound. Graham emphasizes that true investors focus on the long term and aim for returns based on the inherent value of their assets, not just short-term price fluctuations. Speculators, however, are typically driven by the hope of making quick profits, often taking higher risks without considering the underlying value of the asset. Chapter 2. The Investor and Inflation. In this chapter, Graham talks about inflation, which is the gradual increase in prices over time. Inflation decreases the purchasing power of your money, so if you keep your money in cash, it will be able to buy fewer things in the future. Graham explains that inflation can harm your investments, particularly fixed income investments like bonds, since their returns may not keep up with rising prices. For instance, if you invest in a bond that pays a fixed amount each year, the actual purchasing power of that bond's payments will decrease over time if inflation is high. However, Graham notes that stocks tend to perform better over the long term because companies can often raise prices or improve their earnings to keep up with inflation. By investing in stocks, you're buying a piece of a company that can grow and adapt over time, which helps protect against the eroding effects of inflation. Chapter 3. A Century of Stock Market History. In this chapter, Graham reflects on the history of the stock market and its fluctuations over the years. He points out that stock prices have had periods of rapid growth, followed by sharp declines. For instance, in the 1960s, stock prices were very high due to speculative buying, but when the market crashed in the early 1970s, many investors who had bought at the peak suffered significant losses. Graham uses this history to remind investors that the market can be unpredictable and that prices can sometimes get out of line with the true value of companies. He advises caution when stock prices are inflated and encourages investors to look beyond short-term trends. Instead of buying stocks based on speculation or hype, investors should focus on the long-term performance and fundamentals of the companies they invest in. By understanding the history of the market, investors can make better decisions about when to buy and when to avoid overpriced stocks. Chapter 4. General Portfolio Policy. The Defensive Investor. This chapter introduces the concept of the defensive investor, someone who is primarily concerned with minimizing risk and preserving their capital rather than trying to achieve the highest possible returns. Graham emphasizes that a defensive investor should aim for a simple, well-balanced portfolio that provides steady returns without taking on too much risk. For example, a defensive investor might split their portfolio equally between stocks and bonds. Bonds provide stability and lower risk, while stocks offer growth potential. Graham stresses that the defensive investor should not try to pick individual stocks based on short-term market movements or trends, as this can be risky and time-consuming. Instead, they should focus on buying stocks from established, well-known companies that offer a consistent performance and regular dividends. The goal is to create a diversified portfolio that minimizes risk and generates reliable returns over time, without requiring constant attention or excessive effort. Chapter 5. The Defensive Investor and common stocks. In this chapter, Benjamin Graham discusses how the defensive investor, who prioritizes safety and stability, should approach common stocks. He recommends that defensive investors buy stocks in well-established companies with a proven track record of stable earnings and regular dividend payments. These companies are usually less volatile and more predictable in terms of their performance, which is important for someone who is looking to avoid unnecessary risk. For example, think of a defensive investor buying stocks in large, well-known companies like Coca-Cola or Procter & Gamble. These companies have been around for years and have shown that they can weather economic downturns. They pay steady dividends, meaning the investor receives regular payments, even during tough times. Graham also emphasizes that a defensive investor should not try to pick individual stocks based on market trends or hot tips. Instead, they should choose stocks from diversified industries and sectors to reduce risk. Diversifying your investments means you're less likely to suffer big losses if one company or industry underperforms. Chapter 6: Portfolio Policy for the Enterprising Investor – Negative Approach. This chapter focuses on the enterprising investor who is more willing to take risks in order to achieve higher returns. However, Graham stresses that this doesn't mean the enterprising investor should dive into speculative investments. Instead, they should adopt a negative approach by avoiding certain types of investments that are more likely to lead to losses. For instance, an enterprising investor should avoid buying overpriced stocks that are based on hype or speculation. This might include stocks from companies that are overhyped by the media, or stocks that have inflated prices due to temporary trends. Graham also warns against investing in stocks of companies with poor financial health, or those in industries that are unstable. The goal for the enterprising investor is to find bargains in the market, companies that are undervalued and have solid potential for growth. In short, while the enterprising investor takes on more risk than the defensive investor, they should still be cautious and selective about where they put their money. Chapter 7: Portfolio Policy for the Enterprising Investor – The Positive Side. In this chapter, Graham shifts to the positive approach for the enterprising investor. While the previous chapter focused on what to avoid, this one explains where the enterprising investor should focus their efforts in order to maximize returns. The idea is to look for opportunities where the market is undervaluing certain assets, allowing the enterprising investor to buy them at a lower price than they're truly worth. For example, let's say there's a company that's experiencing temporary challenges. Perhaps its stock price has dropped because of bad press or a brief financial setback. An enterprising investor might see this as an opportunity to buy the stock at a bargain price, knowing that the company's long-term prospects remain strong. Graham suggests that enterprising investors look for undervalued stocks, bonds, or other assets that have the potential to improve over time. He also emphasizes the importance of doing thorough research before making such investments to ensure they aren't just temporary opportunities, but ones that offer long-term value. Chapter 8: The Investor and Market Fluctuations. In this chapter, Graham explains how market fluctuations, the ups and downs of stock prices, can be both a challenge and an opportunity for investors. He warns that investors should not get caught up in the emotions of the market. When the market is soaring and stock prices are rising rapidly, it's easy to get excited and make risky decisions. On the other hand, when the market is falling and stocks are losing value, investors might panic and make hasty decisions out of fear. Graham introduces the idea of Mr. Market, a fictional character who is overly optimistic when prices are high and overly pessimistic when prices are low. He suggests that investors should treat Mr. Market like a business partner who is occasionally irrational. The key is to remain calm and make decisions based on the long-term value of investments, not the short-term market fluctuations. For instance, if you've invested in a strong company and its stock price drops temporarily due to market panic, you shouldn't sell just because everyone else is selling. Instead, you should look at the fundamentals of the company and decide whether the price drop is justified. If it's not, this might be a good time to buy more shares at a discount. Chapter 9: Investing in Investment Funds. In this chapter, Graham focuses on the idea of mutual funds and other types of investment funds, such as exchange-traded funds, ETFs. The core principle here is to understand how these funds work and whether they're a good option for investors. Graham suggests that many investors find it more convenient to invest in funds instead of picking individual stocks. Funds are managed by professionals who choose the stocks or bonds in the fund, offering investors the advantage of diversification without having to pick and choose specific companies. Think of a mutual fund like a basket where the fund manager puts a variety of fruits, stocks, bonds, etc. Instead of buying each fruit individually, you buy the whole basket, which gives you a mix of different investments. However, Graham warns that not all funds are created equal. Some funds charge high fees, which can eat into your returns. Also, the professional managers might not always make better decisions than an investor could on their own. The key takeaway here is that funds can be a good option for some investors, especially if they are looking for diversification and don't have the time or expertise to manage their own portfolio. But it's important to carefully consider the fees and track record of the fund manager before investing. Chapter 10: The Investor and Their Advisors. This chapter discusses the role of investment advisors and how investors should work with them. Graham explains that investors often need help in making decisions about their portfolio, but they should be cautious when choosing advisors. An investment advisor is someone who provides recommendations on where to invest. They might charge a fee for their services or take a percentage of the assets they manage. However, Graham warns that some advisors may have conflicts of interest. For example, they might recommend certain investments because they get paid higher commissions on them, even if those investments aren't the best option for the investor. Graham suggests that investors should look for advisors who are truly acting in their best interests. One way to ensure this is by choosing an advisor who charges a flat fee or works as a fiduciary, meaning they are legally required to put the client's interests first. It's also important for investors to educate themselves so they can ask the right questions and make sure the advisor is recommending suitable investments for their goals. Chapter 11: Security Analysis for the Lay Investor. General Approach. In this chapter, Graham introduces the concept of security analysis, which involves evaluating a company's financial health and its stock to determine if it's a good investment. Graham emphasizes that even if you're not a financial expert, you can still do basic security analysis and make informed investment decisions. Security analysis involves looking at the company's financial statements, such as its income statement and balance sheet. For example, if a company is making a lot of money but has a lot of debt, that could be a red flag. On the other hand, a company with low debt and steady earnings might be a safer bet. Graham suggests looking for companies that are undervalued, meaning their stock price is lower than the actual value of the company based on its earnings, assets, and growth potential. For example, if you find a company that has consistent profits and strong assets, but its stock price is lower than it should be due to temporary issues like bad press or a short-term market dip, that could be an opportunity to buy at a discount. Graham also emphasizes the importance of sticking to what you understand. If you don't understand how a particular business works, it's probably not a good idea to invest in it. Chapter 12: Things to consider about per-share earnings. In this chapter, Graham focuses on the concept of earnings per share, EPS, and how it's used by investors to assess a company's profitability. However, he cautions that EPS is not always the best indicator of a company's value. EPS is simply the portion of a company's profit allocated to each outstanding share of stock. It's often used as a quick way to gauge how profitable a company is. But Graham explains that EPS can sometimes be misleading. Companies may manipulate their earnings to make their EPS look better, such as through accounting tricks, or by buying back shares to reduce the number of shares outstanding, which makes the EPS appear higher. For example, a company might have a high EPS, but if it's taking on a lot of debt or cutting corners to improve its numbers, the profit might not be as sustainable as it seems. Graham advises investors to look at other factors besides just EPS, such as the company's overall financial health, its growth potential, and the quality of its earnings. It's also important to consider how the company's earnings compare to its stock price. If the stock price is very high relative to the earnings, it might be overvalued. Chapter 13. A comparison of 4 listed companies. In this chapter, Graham gives a detailed comparison of 4 companies to illustrate the process of analyzing stocks. He compares 2 groups of companies, each consisting of 2 companies that are similar in nature but differ in terms of their financial health, stock prices, and other important metrics. The core principle here is that it's crucial to evaluate a company's financial health before deciding to invest in its stock. Graham emphasizes that a stock's price should reflect the underlying financial reality of the company, not just market hype or speculative trends. For example, if 2 companies are in the same industry, but one is growing its profits steadily while the other is struggling with debt, the first company may be a safer investment. He also points out that investors shouldn't just look at the price or past performance of a company's stock. You need to look at the company's financial statements, such as its earnings, debt levels, and asset quality, to determine whether the stock is undervalued or overpriced. By comparing these companies, Graham highlights the importance of looking for stocks that offer good value for money. In simple terms, it's like buying a product that works well and is offered at a reasonable price. If you know what to look for, you can make smarter investment choices. Chapter 14. Stock Selection for the Defensive Investor. This chapter is about how a defensive investor should choose stocks. A defensive investor is someone who wants to minimize risk and is not looking for high returns or big risks. Graham suggests that defensive investors should focus on safety, not speculation. The core principle is that defensive investors should prioritize companies with a proven track record, stable earnings, and low debt. For example, if you're investing in a company like Coca-Cola, you're looking at a business with a history of stability and steady profits. The company's products are widely used, and it has strong financials that can weather economic downturns. Graham advises defensive investors to choose stocks of large, well-established companies in industries that are unlikely to change quickly, like utilities or consumer staples. He also suggests keeping the portfolio diversified to reduce the risks. This means not putting all your money into one company or one type of stock. Think of it like not keeping all your eggs in one basket. If one basket falls, you still have others to rely on. Chapter 15. Stock Selection for the Enterprising Investor. Unlike the defensive investor, the enterprising investor is willing to take on more risk for the potential of higher returns. Graham advises these investors to look for opportunities where they can gain an advantage, such as in undervalued stocks, special situations, or smaller companies that might grow quickly. The key principle here is that enterprising investors should be willing to put in the time and effort to research companies that are undervalued or overlooked by the market. For instance, if a company's stock price has dropped because of a temporary issue, but its core business remains strong, it might be a good opportunity to buy the stock at a low price. Graham also mentions that enterprising investors should be patient and avoid making decisions based on emotions. They need to do thorough research and carefully analyze the financial health of the company before making an investment. A great example of this is buying a stock when others are fearful and the price is low, and selling when the price goes back up as the market regains confidence. However, Graham warns that most people are not cut out for this type of investing. It requires a lot of time and effort to truly understand the companies and the market dynamics. It's not something that can be done casually or by following the crowd. Chapter 16. Convertible Issues and Warrants. In this chapter, Graham introduces 2 more complex types of investments: convertible bonds and warrants. Convertible bonds are bonds that can be converted into stocks, while warrants give investors the right to buy a company's stock at a specific price before a certain date. The core principle here is that these investments can be appealing because they offer a combination of fixed income, like bonds, and the potential for growth, like stocks. For example, a convertible bond might pay you interest like a regular bond, but it also gives you the option to convert it into stock if the company performs well and the stock price rises. However, Graham advises caution when investing in these instruments. Convertible bonds might seem attractive because they offer both safety, the bond, and the potential for stock gains, but they often come with lower yields compared to regular bonds. Similarly, warrants might look appealing because they allow you to buy stock at a set price, but if the stock price doesn't rise as you expect, you could lose money. Graham points out that these types of investments can be risky if not properly understood. He encourages investors to carefully evaluate the terms of these securities, such as the price at which conversion can take place and the time limits before investing in them. Chapter 17. 4 extremely instructive case histories. In this chapter, Graham examines 4 different case histories of companies that experienced extreme market events. By looking at these real-life examples, he wants to show how investors can make better decisions based on rational analysis rather than emotions or market trends. The core principle here is that it's important to learn from both successes and failures in the market. Graham discusses 4 companies that had different outcomes. Some did well, while others faced major problems. For example, one company might have been overhyped and priced too high, leading to a market collapse. Another company, while undervalued, might have turned out to be a good investment after a period of poor performance. Graham emphasizes that investors should focus on the long-term financial health of a company rather than reacting to short-term fluctuations. If you're invested in a company and it hits a rough patch, rather than selling in panic, you should analyze whether the company's core business is still strong and if its stock price represents good value. The key lesson here is that success in investing doesn't depend on luck or timing the market, but on making sound decisions based on careful analysis of each company's fundamentals. Chapter 18. A comparison of 8 pairs of companies. In this chapter, Graham compares pairs of companies in the same industry. He looks at how different businesses within the same market segment can perform under similar conditions, emphasizing the importance of careful selection. The core principle here is that when comparing companies, you need to go beyond surface-level similarities. For example, 2 car companies may both operate in the same industry, but one might have higher debt, weaker financials, or lower growth potential than the other. These underlying differences matter far more than just the industry they are in. Graham urges investors to pay attention to the company's financial strength and its ability to manage risks. It's like buying a car. Just because 2 models are from the same brand doesn't mean they'll perform the same. You need to evaluate things like fuel efficiency, safety features, and cost before making a choice. This chapter teaches investors to do more than just choose companies based on industry. They should dig deeper into the financials, leadership, and long-term growth potential of each company. Chapter 19. Shareholders and Management, Dividend Policy. In this chapter, Graham talks about the relationship between shareholders and company management, focusing on the importance of dividend policy. He discusses how a company decides whether to pay dividends to its shareholders or reinvest profits back into the business. The core principle here is that investors should understand a company's dividend policy, as it can reveal a lot about its financial health and future prospects. If a company regularly pays dividends, it might indicate that it is stable and confident in its cash flow. However, some companies, especially younger or high-growth businesses, may choose to reinvest profits into expanding the business rather than paying dividends. For instance, consider a company like Apple, which initially didn't pay dividends for many years. Instead, Apple reinvested profits into expanding its product line, eventually leading to massive growth. On the other hand, a company like Coca-Cola pays regular dividends, showing it has steady profits and a long-term growth outlook. Graham advises investors to look at dividend policies in the context of the company's overall strategy. A consistent, reliable dividend policy might indicate a healthy company, while an unpredictable one could suggest financial instability or poor management decisions. Chapter 20. Margin of Safety as the central concept of investment. This chapter introduces the most important principle in Graham's philosophy of investing: the margin of safety. The margin of safety means buying an investment at a price significantly lower than its intrinsic value, which helps protect against unforeseen risks and market downturns. The core principle here is that by buying a stock at a price below its intrinsic value, you are reducing your risk. For example, if a company's stock is worth $100 based on its earnings, assets, and future prospects, but you can buy it for $60, there is a built-in cushion, the margin of safety, to protect your investment. Graham uses the analogy of buying a house at a discount. If the house is worth $500,000, but you can buy it for $400,000, there's a margin of safety in case the property value decreases. Even if the value drops, you're still not at risk of losing money because you purchased it below its intrinsic worth. For investors, the margin of safety is about ensuring that even if things go wrong, such as a market downturn or unexpected company challenges, you still have some protection. It's like driving a car with seatbelts and airbags. While you don't plan to crash, having these safety measures in place helps minimize potential harm. Graham emphasizes that this principle is the key to successful investing. It's about being cautious, not speculative, and always buying with a cushion to protect against losses. That's the end of the book, The Intelligent Investor. But your journey as an investor is just a beginning. Remember, it's not about beating the market. It's about achieving your own financial goals with clarity and confidence. Make sure to like, share, and subscribe to our channel, and click the bell icon to never miss an audiobook.